Folks, when Anna Kelly takes the time to write a blog post, especially a detailed blog post writing about the commercial real estate meltdown, I pay attention. You should pay attention. So let's talk about Anna. Let's talk with Anna about what is in the article. Let's tell them where folks can find it because it was well worth the read. Anna, great job as always.
Thank you so much. A lot of people have been asking me, Michael, whether they're general partners in deals, whether they're limited partners, investors in deals, and they're seeing all of these commercial real estate deals basically unwind, fail, big companies going into foreclosure, handing over the keys, from big office buildings in San Francisco to multifamily deals across the country as well, saying, what in the world is going on? Is the pain over? Am I going to lose money in my deal that I'm running? How do I, get past the next several years of potential, higher for longer rates, and not lose my investors' money? And then if you're passive, what questions do I ask my general partnership? And am I going to lose money? Is all of commercial real estate crashing? It's the number one concern that I hear from everybody that's involved in commercial real estate. And so I thought, you know what, let me just put pen to paper and explain what's really happening. And because if people don't understand what's really happening, then they're afraid of it happening to everybody, but they don't know what to do about it. And so basically, if you go out to my website, annakellyinvesting.com, and you click on the resources and the blogs, you'll see my most recent post where I go into a lot of detail as to, what is it that's happening? How can we mitigate it? What's the light at the end of the tunnel? And what's the positive news of what can come out of this as well? Because in every pain, there's also opportunity, as we've talked about many times on the show, whether it's residential or commercial real estate. So that's basically what it's about. And the key things that I talk about are really the rapid, sudden, and high rate of change of interest rates and how that impacts any type of asset that's interest rate dependent. And so, we've talked about a little bit last week on this show, the idea of a risk-free rate of return. And so when investors are looking at how do I value, the stock that I'm going to buy, the PE ratio or EBITDA, you're looking at basically financial metrics and saying, okay, if a treasury is only paying me 1%, which it was a couple years ago, and I want to make more than 1%, then what can I buy that's going to create better returns? And so what they do is they start with this risk-free rate of return. This is like investing 101 when you talk to your financial advisors. And they say the risk-free rate of return is the US Treasury. That's like the gold standard, or, used to be the gold standard of what was considered low risk.
Might be silver standard now. Sorry.
Yeah, or even worse, maybe copper, I don't know. But essentially, you start with that risk-free rate of return, and then you demand a risk premium for anything else you buy. And so you say, okay, let's talk Class A multifamily. Class A multifamily is considered one of the least risky things you can buy to give you a decent return above the treasury rate. And historically, Michael, the spread between the treasury rate and the rate of return you would expect if you paid all cash for a Class A brand new apartment building is 230 basis points. So essentially 2.3%. So if a treasury's at 2, I want to make 4.3% return on my money if I buy all cash for a multifamily asset. And guess what Class A multifamily was trading for in the last couple of years? In that 4% range.
Yeah.
And in some cases, sub 4, like 3.8% in Phoenix. And in some cases, just a little bit above 4. But as you move up, you go from Class A multifamily, then you have, Class B multifamily, you have office and industrial and self-storage. And each one of them kind of climbs up that risk ladder where you expect to make higher rates. So why does interest rate changes affect values of properties? Because if my risk-free rate of return goes from 2 to 4.5, I'm just going to say 4.2. Okay. You have a 4.2 treasury. Then historically, I'm going to want 2.3 above that. I'm going to want 6.5% return on my money if I pay all cash. Well, if I'm paying all cash and I want a higher return for the same asset, what do I have to do on price? I have to pay a lower price in order to get that same return. So as interest rates, the Fed basically said back in 2020, 2021, we're not going to raise rates. They said we are not going to raise rates. And I heard the argument all through commercial real estate. The Fed's not raising rates, so we don't have to worry about a variable rate mortgage. So they purchased the property with variable rate mortgages, expecting they would be in and out in 2 to 3 years with short-term debt that matured in 2 to 3 years. And suddenly, because rates are so much higher, those that do pay cash want to pay less for the property. So property values have fallen. And even worse, Michael, most institutional level investments are actually bought by a lot of syndicators over the last several years, private investors. And so what are we doing to buy those properties? If I do a $40 million deal, Michael, I'm not paying cash as a syndicator. I'm getting a loan of 75% to 80% LTV, and then I'm raising the rest from investors. And so when the rate goes up significantly, now my cost of my debt has gone from, I have loans, Michael, set for 10 years, thank God, at 3.5% on apartment buildings. Okay. If those had to reset today, they'd be at 7.5% to 8%. So your debt payments to service a property have more than doubled. And if you want to go, if I try to sell my property and a buyer wants to come buy it, they're having to raise, now they're not getting 80% LTV. The bank might give them 60 or 65% of the purchase price.
Maybe.
So that's now at 8 on a 4 or 5 or 6 cap investment. Your debt cost is more than what you would make if you paid cash. And then you've got to raise money, 40, 50% of the total purchase price and reserves from investors who want 20. Your blended cost to purchase that property is now in the 15% range instead of in the 8% range. So buyers can't make the numbers work without significantly reducing what they're going to offer for. And all of that works together to say commercial real estate prices have tanked. They've come down about 20 to 25%. Just because interest rates have changed in terms of both the risk premium and the cost of debt. And so that's put many, over $1 trillion, and there's different stats, but at least $1 trillion of commercial real estate that has variable rate debt that's resetting in the next year. And some statistics I've read across all commercial real estate said you've got another $1 trillion in 2025 and about 800 or 900 billion in 2026 of these loans that are coming due at more than double the interest rate, which is going to continue to have pressure on prices. And it basically puts even really good operators that have been doing this for a very long time, who have completed their value add, increased their rents, cut their expenses. All of a sudden, now they're having rents that can't keep up with the cost of that new debt, taxes and insurance going up, vacancies ticking up, credit delinquencies ticking up, and all of these things are happening at the same time. And it leaves operators and investors with very limited options for what they can do to survive through this over the next couple of years and not lose their property to the bank, which means all of their equity, all of their investors' investment is completely wiped out. So that's kind of the bad news of the backdrop. But my post really goes into some examples of dollar for dollar, how just the change in debt and what that does to value can really completely wipe out an investment on an otherwise really good and profitable income producing property.
Yeah, it was a wonderful article. Lots of examples. Again, folks, where can they find it, Anna?
Great. Again, you can go to my website, annakelleyinvesting.com, and look at the resources in my blog posts, or you can go to social media to find it as well. And I do give it's not all doom and gloom. It's explaining the doom and gloom, but I give you some pointers for things that you can do to keep those assets afloat, to survive. We say survive through 25 if the Fed actually, continues this higher for longer rate environment. And also some ways that you can find distressed assets and take advantage of those opportunities to buy properties for sometimes below replacement cost.
Yeah. And that's where I want to go next. I just wanted people to know, because I think they're going to be hearing you speak and they want to go get it. I think the fact that you closed with kind of the opportunity coming, I think the opportunity that's coming in the small commercial, where I like to play the 5s to 40s, I really believe that it could be as good as the residential crash of 2010 and 11. I expect to get the opportunity to buy assets significantly below their last sale price. I've been calling this for a while because I sold stuff at near the peak. I'm like, these guys are paying stupid prices. I think that's going to come home to roost, especially if they have short-term bridge debt. What I really took from your article is the pain that I see coming actually might be, it might be slower, but actually last longer. So the totality may be higher. That was really my takeaway from like the last third of the article. It's like, Michael, I know you're excited. I know you're ready to go, but it'll probably be slower, but it perhaps could be in totality bigger. Was that a fair takeaway from the end of the article?
Yes, I think so. And part of that is because, again, this distress, it's not all happening right now. It's this lag effect. So we talk about the lag effect with interest rates and have we seen the pain yet? There is a true lag effect that the fact is not everybody's loans are due today. So we don't see just a crash in, hundreds of these properties being
Right.
handed back to the bank. We see a couple every week in the news, for commercial real estate. But the fact is most of these amazing deals, when we looked back and thought these are amazing deals because we could get such low interest rate debt that we didn't anticipate. No matter how good you are, nobody anticipated the Fed funds rate going up 5% in a year. Maybe you think a percent, and so you bump up your exit cap, and we all kind of did that. But essentially, between 2020 and 2022, is beginning of 2022 is when all of these bridge debts were done. And they were generally 2 to 3 year terms with
Right.
maybe up to 2 1-year extensions. So if you go back to 2021 and you just play, okay, the bridge lenders are going to give them those 2 1-year extensions. You've got through 2026 for those loans to all come due. So we're going to start to see them trickle out between now, because you had a lot of 2020ers, their loans were called in 22, they couldn't perform. 21 called in 23. Most of them were 2-year bridge debt, but some were 3 and up to 2 extensions. So we're going to see a wave of them come this year, next year into 2025. And again, the question is, how many banks, back to your point, how many banks are going to say, we understand this isn't an operations issue. You're able to make the debt payments. As long as you make the payments, we're not going to call the loan because of the DSCR or LTV changes. We're going to let you continue, but you got to make those payments. Maybe they even take over lockbox and collect your rents, pay your expenses, and keep the difference. But you might have banks that are willing to work with some of these buyers. And so you're just going to have to really watch for that opportunity over the next couple of years. I will say this. With that said, I do think we've already kind of hit a bottom in multifamily values and in the larger property space, because you're already kind of at the point where values have fallen about 25%. Class C hit harder than Class A or B at this point. And basically, we've kind of said, okay, we think we know that rates aren't going to go much higher. Whether that's true or not, we don't know. But the market's kind of saying, okay, we kind of stay where we are. Maybe we go up another quarter point. So let's just assume that cap rates adjust to that. But in 2 years, when the Fed's dot plot says they're going back down, we're banking on that exit cap. The market is saying the exit cap's going to land where the new Fed funds rate is up 2.5% higher. That means our cap rates have to adjust by that much. And that's about what things are trading at. So I don't see a significant discount to value compared to where things are today on an adjusted cap rate basis, but you're going to have a breadth of a lot more of these properties that are distressed that you can take advantage of, those lower prices. And in some cases, Michael, it is cheaper than replacement cost, just because of the debt structure. So
Yeah.
look for multifamily sellers that have owned their properties for, 1 to 4 years. They're probably the ones that are distressed and going to be willing to negotiate, hopefully to at least the amount of their debt so that they can walk away. Or if you do have some that are assumable that just can't make their value add work, deal work, assumable loans, can do a lot for you in helping with your returns, as long as you're modeling a good exit cap rate that's higher than where they are today.
All right. One more time, Anna, where can they find this amazing article?
Great. Thank you so much. If you follow me on social media, you can find it on my Facebook or LinkedIn at Anna Kelly, REI Mom, and my website, AnnaKellyInvesting.com.
Thank you so much. Great work again. It was a great article.
Thank you.